Good afternoon, everyone. Today I'm chatting with Andy Schectman from Miles Franklin. In this interview, Andy gives us insights into the state of the current gold market. He gives us some of his thoughts on why there's certain transactionings happening between London and the US and some of the other gold exchanges. And he tries to make us make sense of everything that's happening from a geopolitical perspective when it comes to gold. All right, everybody, enjoy the interview. Andy, thanks for hopping on today.
Well, it's good to be here. I appreciate the invite very much, Steve, and looking forward to it.
Well, look, there couldn't be a better day to have you on here because we've been trying to get you on here for years and we finally connected. And last night, gold hit $3,500 in the spot market. I kept waking up in the middle of the night and checking the price. Now, primarily what we do on our channel is we cover the equity side of gold miners, but we have to understand the macro to really understand what's happening here, what these miners are actually going to look like moving forward if these prices persist. And having you on right now is just the perfect opportunity to kind of get into that for our audience. So maybe, and normally I never ask people this when we start off an interview, but my understanding is you work for a company called Miles Franklin. Just to sort of set up this interview, maybe you could tell us a little bit about Miles Franklin.
Yeah, I started it when I was 19 years old, 35 years ago. We've been around since 1989, before the internet, if you can believe that, when you had to use USPS and FedEx to send things out to people. Well, there was no email or text. It was a different world back then, but I think of the journey to where I've gotten to now. It's been amazing. We've done over 12 billion in sales without a customer complaint. We started from nothing, and I think it's important for people to understand, and I'll explain to you the way that I look at gold as we proceed, and I will comment on the mining shares as well. But I started on a wing and a prayer with my father, whose middle name is Miles, and his best friend who loaned us $60,000 in 1989 to start a company, as I said, before the internet, in an office the size of a closet. I think of where we've come from and how we've gotten here, and it blows my mind every day, honestly. The way that I look at gold is a little bit different maybe than most analysts. So when I started this company, again, I was 19, and my dad said to me, "Look, I'm not going to let you make the same mistakes that I made as a younger man. You're going to buy something every 2 weeks. It's the only rule that I will ask of you as we start this journey. When you get paid, every 2 weeks, you buy some gold or some silver or whatever it is. I don't care how much. I don't care if it's 1 ounce." That lesson was the greatest gift my father has ever given me. And he taught me the laws of compounding, how to let it be your friend instead of your enemy. He taught me how to pay myself first, to have a discussion with my 54-year-old self saying, "Hey, man, life gets expensive. You're going to have kids and college educations and weddings, and life is expensive. So prioritize yourself." And I've owned the company now outright for almost 2 years, and I still talk to my dad every day, but he won't fire me anymore. He once said that would be the only reason he would ever fire me is if I disrespected that. Um, but I've honored my promise to him, and for 35 years, I've never missed a 2-week period. And I will tell you, to any young person watching this, it is the most important thing I could ever say to a young person who's beginning their journey. Pay yourself first. I still feel like I'm 19 in my mind sometimes. And, you wake up one day and it's like, the old saying, days are long, but the years are fast. You wonder how the hell did all that time go by? And people make the mistake of, you know, living on credit and letting those laws of compounding work against you. So my journey to where I've gotten to here centers around looking at gold as wealth, not as an investment, money that I hope I never need to use. If I do, I'm damn glad I have it. Doesn't always have to be for an emergency. Could be a hell of an opportunity, as gold has appreciated by 9.9% per year for the past literally 25 years on average. It's outpaced anything traditional. And quietly, it's the tortoise, not the hare. And so I think that that's really where I start from. I look at gold as an asset that has outlived two world wars and German hyperinflation and the Great Depression and every pandemic. And it's still, here we are 5,000 years after it's been listed or written about 400 times in the Bible. And when I say gold, I mean silver too, by the way. But here we are all those years later, and we have, I guess you could say, the more things change, the more they stay the same, because you have the most well-informed and well-funded traders on the planet, the central banks, buying gold at a level the world has never seen. So as we go forward on this interview today and talk about gold and silver, please understand, to me, it is more a form of wealth than it is anything else. And I swear to you, every single time I get online, every single freaking time my dogs start barking. So it wouldn't be natural if they didn't do it here today. Knock it off. But I'm glad to be here and happy to jump in and answer questions. But just understand, to me, it's all about wealth and preservation of wealth and retaining your purchasing power. The mining shares, on the other hand, can make you very wealthy, and happy to dig into that as well if you'd like.
So when you say Miles Franklin has sold billions of dollars worth of gold, just so that I kind of understand a little bit about sort of what you guys do, you guys are sort of like a broker of gold.
Yeah, so
Is that the
we
best way to
sell
describe it?
physical metal. We sell American Eagles and Canadian Maple Leafs and Krugerrands and gold and silver bars. For physical delivery, we also have storage all around North America: Toronto, Montreal, Vancouver, um, Los Angeles, Salt Lake City, Dallas, Miami, New York, and North Dakota. We believe in physical ownership, and it is either sent directly to you, invested through your IRA, or stored in a facility of your choice, whether it be the nine or so that we control through Brinks, or one of your choice. So that's no problem at all. But it's physical delivery of physical metal, um, is in essence what we do.
Okay, so you mentioned physical delivery, so let's get into this because this is the hot topic right now in the gold world. We had the COMEX recently have that. I guess they said it was an error, is my understanding from what I followed on social media and chatting with Craig Hemke. I'm not sure if you know Craig. I assume you
I
do.
love Craig,
Um,
smart
and
man.
and my understanding is that we had this massive physical delivery order that was left open on the last day of trading last month, and it looked like somebody was set to take delivery, and then a few people reached out to the Comex and they said, well, that's not the case, it's just an error. uh, what happened there? Can you give us a little bit of color on how you viewed the events there?
Yeah, they said it was an error. I mean, I don't know if I believe it or not. I guess it could be. It certainly looked as though that was happening. The open interest was massive, which looked as though they were standing for delivery at the last day. But regardless of that, what we are seeing is, since November, the United States has become a net importer of gold. North of 60 million ounces that we know of have been delivered into the COMEX. Gold is the only other tier one reserve asset in the world, according to central banks, and that was reclassified by the Bank of International Settlements. It's U.S. Treasuries, and that's where it's been since the end of World War II, and since 2019, now gold. Now, let's just sidestep the fact that that could have been an error. Maybe it was, maybe it wasn't. We've seen tremendous deliveries into COMEX, more so than we've ever seen. And we've seen most of it coming from the LBMA in London, where they are a T+1 settlement exchange, where if you stand for delivery on your trade, it's T+1 is a settlement. On the third day, the metal should be moving. So much has come out of the LBMA. I think they've spooked the LBMA because of their rehypothecated position. I'll explain that in a moment. They've now all of a sudden gone to T+8 weeks. And they say it's a shortage of trucks and manpower. So the Bank of England evidently is short on trucks and can't make the delivery demands that are set upon them. To give you an idea, they have somewhere in the neighborhood of a float of 36 million ounces of gold, but yet that's standing behind somewhere in the neighborhood of 280 or 300 million ounces in open spot contracts. In other words, if every one of those contracts stood for delivery over 300 million ounces, roughly, there's only 36 million ounces for delivery. That's a problem. And on silver, the LBMA has approximately 100 and I want to say, what is it? 160. Let me just double check that. No, it'll be 260 million ounces in that neighborhood of silver that is unencumbered, right? They have 780, 760 total on the LBMA in their vaults, of which over 500 belongs to the ETF. So about 260 million ounces are supposedly available in London, but they trade 2.9 billion ounces per day, 3.5 times annual global mine supply. Again, if everyone stands for delivery, we got a big problem. And so all of a sudden, they've gone from T+1 to T+8 weeks, which is a big issue because they say it's just a shortage of trucks. Imagine you have a multinational jewelry business and you own these contracts so that you can fabricate your jewelry. Sorry, guys, we apologize. I know you're expecting your metal, but it's 8 weeks because we don't have enough trucks. This is almost the form of a default. Most of that metal is coming into the United States. As I've mentioned, we've become a net importer of the only other tier one reserve asset next to U.S. treasuries, which the world seems to be shedding. The central banks are selling treasuries and buying gold, which has doubled the performance of the 10-year treasury since the turn of the century, doubled it with no counterparty risk. In other words, it can't be sanctioned, can't be taken from you. And what I find really interesting above all else is the tweet that Trump came out with on April 20th, 2 days ago, at 3:09 p.m. on Truth Social. He says, "The golden rule of negotiating and success: he who has the gold makes the rules. Thank you." Interesting. U.S. has become a net importer. J.P. Morgan delivered $4 billion of gold the end of February into COMEX for a customer. Who's that customer? Could it be the Treasury? Could it be the Fed? Could it be Warren Buffett? We saw the largest deliveries into the COMEX in its history over the last several months. And so as gold is coming in, which is the only other tier one reserve asset, you have all sorts of noise around the periphery, whether it be gold is held on every central bank balance sheet, including the United States, in something called the gold revaluation account. You can't make that up. When Nixon closed the gold window in 71, he revalued gold. It was at 35 bucks. He revalued gold the next year, 72 to $38, which means he devalued the dollar. And then the following year, 73, revalued it to 42.22, where it stayed on the balance sheet ever since. In 33, over my shoulder, when Roosevelt confiscated gold, it was at $20 an ounce. He paid everyone $20.67. Well, if eggs are a nickel for a dozen back then, 67 cents is good. And then he devalued the dollar immediately by 40%, in essence, revaluing gold at 35 an ounce, where it stayed until Nixon closed the gold window in 71. So we see all sorts of talk, whether it be the head of the German Bundesbank and several of their board members, the head of the Dutch National Bank, both screaming, we need to revalue the gold, which in Europe, it's at 35 an ounce still since the end of World War II. It's still there. We need to revalue gold and value it at least market to offset the liabilities on our balance sheet. And then you have Senator Loomis from Wyoming here talking about the exact same thing. Hers was in reference to funding a Bitcoin strategic account. Let's sell or revalue the gold, rather, that supposedly is being held by the Fed at Fort Knox, at the Federal Reserve Bank of New York, at the West Point Mint, and at the Mint in Denver. So when they talk about auditing Fort Knox, there's more than just Fort Knox. There's all those other places. But let's revalue it and use some of the proceeds to buy Bitcoin. So there are people even talking like James Rickards and using a 40% gold backing and dividing that number of ounces that we supposedly hold, over 8,300 metric tons, into the money supply, or 40% of it. And the number he comes up with is $24,000. The mechanics behind that are kind of weird. The Treasury would issue what's called gold certificates to the Fed which is collateral in essence. The Fed would print money and give to the Treasury. I'll explain that in a moment. But they don't get right to the gold. It's an accounting gimmick. They get right to the cash value of the gold. The Fed does. So it still belongs to the Treasury and to the American people. But every $4,000 increase in the price of gold, the Fed would, in essence, give the Treasury, based upon the number of ounces, $1 trillion free and clear to use however they want. At $24,000 an ounce gold, the Federal Reserve would, in essence, give the Treasury $6 trillion, what they could use to pay down debt or back what Judy Shelton says. I interviewed Judy. Judy is a brilliant woman. She was Trump's nominee to run the Fed in 16, and many think she'll run it here when Powell retires or when his tenure is up. She's advocating for issuing gold-backed treasuries, 50-year to start with and shorter duration after, redeemable at the end, with stable coins issued off of it. But she told me flat out on my interview with her, which people can go and listen to on our Miles Franklin YouTube channel, that Trump will issue gold-backed treasuries on July 4th, 2026, that they've talked about it. That's the 250th year anniversary of the country. In a world where no one wants our treasuries anymore because of inflation, weaponization, volatility, et cetera, this would inspire confidence. Now, if that is the truth, if you really are going to issue gold-backed treasuries, now let's take a step back. Well, the first thing you would need to do would be to reshore all the gold that has been lent all around the world. So you start delivering it all under the guise of tariffs. And then at some point, the Bank of England says, holy shit, this is not just tariffs. They're draining us and we're in big trouble because we are way over leveraged. We have way more paper than we do bars, and no one's ever stood for delivery, but look what they're doing to us. All that metal's coming back and we're in trouble. So wait, we don't have enough trucks. Tell them it's an 8-week delay. Maybe we can get our house in order by then. Don't know. Gold is the only other tier 1 reserve asset next to what? U.S. Treasuries, which everyone is selling. So how do you inspire confidence? Well, you issue treasuries backed by gold. Give it another year and 3 months before you issue them. Keep letting gold rise little by little by little, which isn't getting noticed by anybody except guys like you and me. And then maybe we'll revalue it market to market at some point or even higher and peg it to a new system where treasuries are redeemable in gold. Now, there's a lot of fact in what I just said, a little bit of supposition, but what I will tell you is that the deliveries into COMEX are real. Whatever they want to tell us about that being a glitch or an error, maybe true, maybe not. Maybe they just panicked and told everyone, we got to cash settle you for now. This is a problem. I don't know what they did. And maybe it really was a glitch. But the fact that United States, the first time in my career, has become a net importer of gold, the only other tier 1 asset in the world, all this gold is flowing in, and you have all of these entities at high levels talking about revaluation, pegging it to a treasury system, redeeming it that way. All of these things are coming together at the same time. And here we have gold at almost $3,500 an ounce, and there's not a damn person in the mainstream who's talking about it. Gold is not reacting to something. It is being quietly reintegrated into the fabric of the new monetary system. That's my belief, and that's why it hasn't caught the attention of the mainstream yet, which if you would have told me at any point in my career gold will be 3,500 an ounce and no one will be talking about it, I'd say you're out of your damn mind. But for all of those of you out there that are wondering about timing, the fact that the retail public is completely asleep at the switch on this, and the only people really accumulating it are the sovereign wealth funds and the central banks, this commercial banks, and some very sophisticated in-the-know people, should tell you we got a long way to go on this one, a long way. And to me, it's just the very beginning of what should be a hell of a run on gold.
Well, um, a lot of thought-provoking things you said there, and you kind of tie it all together nicely. Just mentioning the COMEX thing and just kind of hearing you talk about it, I have to say it does like you would think about the mechanics of how an exchange works. Like, how would you just end up with that error, right? Like clearly nobody cleared that trade, right? How does that even happen?
Well,
How do
that's
you
the point. That's the point. I don't know. I mean, the person that would know that would be Craig. And I read when he wrote that, and I accepted it because Craig is, with God rest the soul of Ted Butler, who passed away last year, who was the preeminent expert on the COMEX. When I interviewed Craig, who I consider a friend, I told him, this was maybe 3 months ago. I said, "You are now the torchbearer of the expert on the COMEX and its inner workings." So when he says that, I don't take it with a grain of salt. I think he knows what he's talking about. I have no idea how they would do that. To me, everything that happens at that level on the COMEX and the CME group, which is completely and totally full of shit, to me, um, rings of conspiracy, fraud, not being true. They have allowed the markets to be rigged by the commercial banks for a very long time, and the suppression that is very prevalent in the COMEX and has been for a very long time, where a handful of Western banks can, in essence, control the price of gold and silver with naked shorting, which means you're shorting without the metal behind you, creating more and more and more and more shares that are what's called rehypothecated off the same ounce of gold. In other words, if everyone stood for delivery, it's exactly what the Hunt brothers noticed in 1980, way more paper than there are bars. And if everyone stood for delivery, well, Houston, we got a very, very big problem. And that's the point. It's that everything that they've allowed to happen, is horrible when you talk about the investors and the miners and all the people who have invested in the precious metals industry. They have allowed a handful of Western banks, in essence, to control the price, um, and that's changing. It's changing right in front of us because, in fact, they've lost control of gold because the contracts all have delivery options. You can stand for delivery. During my entire career, no one stood for delivery, less than 1%. In 2020, when I started doing interviews, I'm like, there are entities standing for delivery. Now, I don't want to get too far into the weeds, but every week, and Craig is the expert on this, every week, the COMEX publishes what's called a commitment of traders report, which it shows the positioning of the largest traders. And it's always been on one end, the commercial banks, JP, Goldman, Citi, B of A, and the specs on the other end, the speculators, the hedge funds. And those are the two that they would show. And then in 2020, all of a sudden, there's a third group of reportables that pop up on this commitment of traders report that no one had heard of before, called the others. Well, what the hell are the others? Who are the others? The others are believed to be sovereign wealth funds, largely, maybe big family offices. And in 2020, all of a sudden, we start to see huge deliveries to the others. And so when you see the central banks, and their, by proxy, the sovereign wealth funds quietly standing for delivery, something was changing. Well, this is accelerating. And the countries in the BRICS primarily, well, they understand that that is the Achilles heel to the Western system, is the delivery mechanism. And we've seen deliveries now going on for 4 years that are in essence slowly and quietly draining the exchanges. This is what's very different. So you can create a perception of reality through suppressing and shorting the paper contract. But when you short, that means someone goes long on the other side. And when that happens, if they stand for delivery, well, you better come up with the metal. And that's what the Bank of England is going through right now, or the LBMA. This is why shorting, naked shorting on COMEX contracts is as dumb as a mud wall right now. And I think that's why you're seeing metal continue to rise, because people are standing for delivery. And it'd be very foolish to try and naked short something that you do not have the ability to deliver right now. And that's kind of why I think the price is stepping higher.
There was a story here in Canada that, somebody on Twitter was talking about a few years ago, named Mario Vitro, who, I'm sure I could find the Twitter thread, but he talked about how once they executed the perfect short squeeze where they knew exactly where all the shares were, and, they knew that there's a big naked position, and what they did was they all actually called for physical certificates of their shares, which basically made the naked shorts have to cover. And what the exchange did, and I don't remember which exchange it is, so I'm not gonna say which one, but it was one of the junior ones here in Canada. And, they basically just unwound all the trades because the losses could have been infinite, right? Like, when you have a large naked short position and, you can't deliver those shares and the other side they have you in checkmate, well, basically they can bankrupt you. And for some reason, obviously we have problems with our capital markets here in Canada, as I'm sure you're aware of. But then you hear about what you're talking about with naked shorting of physical. We're not talking about tiny little entities like some little guy in Vancouver who executed the perfect short squeeze. We're talking about, I assume, massive commercial banks, uh, central banks,
And hedge funds.
hedge
That's right.
funds. So, like,
That's exactly what I'm saying. 1,000%. That's exactly what's happening. The difference is COMEX is very similar to your example. COMEX is an exchange, and that's what happened with the Hunt brothers. They noticed there's way more paper than bars. They bought up all the paper, stood for delivery. The COMEX, to protect their own, which are largely the bullion banks, said, no, 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 no. We're going to change the rules on you. You can be short as much as you want, but you can only be long a certain amount, like 1,000,000 contracts or whatever the number is. So everything else needs to be sold right now, which would have otherwise put them in jail. So they had to sell all of those contracts, which drove the price down. But in London, it's not that way. There is no central clearing authority in London. It's a peer-to-peer. It's called over the counter. Me and you, Steve, we strike a deal. And so there is no exchange in essence to protect. You're just blowing up the other entity if you default, and all of the systemic, incestuous derivatives that you maybe are tied to, that can blow them up as well. It's a chain reaction. So what you're seeing in London to me is far more dangerous than what we're seeing on COMEX. But you've explained it brilliantly. That is exactly it. You have someone who is shorting, and lots of shorting, and then gets the price starts to move against them, and they don't have the ability to get either the shares or the bars, and that's a problem. You can lose, literally, you can go bankrupt on shorting because the price can effectively go as high as it can bankrupt you, keep going higher and higher against you. When you go long, you can only lose what you put up.
yeah, but what happens if, let's just say that there's, like, theoretically, let's just say that there's a hedge fund out there that's naked short $10 billion worth of gold. They have the equivalent of what, say, $100 billion loss. Who's on the hook for the other 90 billion? Is it COMEX? Is there any kind of insurance that uh,
Oh,
could cover
it
it?
would just bankrupt that company. I mean,
But somebody's got to
I
come up
don't
with
know
that
if the,
delta, right?
that's a good question. I don't believe the exchange has insurance or the ability to cover those trades. Maybe they do to a small degree. That's a good question. That's a question for Craig. But in essence, it would bankrupt that company. It would bankrupt that hedge fund. It would bankrupt that bullion bank. And the systemic fallout of that is far greater than just that one entity. They're all tied together incestuously. All of them are, especially the bullion banks, with derivatives. And a failure to deliver, especially if it's a bullion bank. When you're talking bullion banks, you're talking JP, Goldman, Citibank, Bank of America, Standard Charter, UBS, Deutsche Bank. One of those banks' failure to deliver or blows up, you can imagine the fallout throughout other markets, as they're not just tied to gold and silver. So it would be bad. Let me put it to that way. It would drive the price up, as someone would have to try and cover, and it would bankrupt the other entity, to say the very least. I don't believe that there's insurance, even though it is an exchange. I don't believe that there is a market maker, if you will, that guarantees all trades, or would have the insurance for that. But it would certainly be a spiritual, religious experience for the entity on the wrong side of that trade.
Andy, I got one last question for you here, and I got to sneak it in here. Silver. Normally, we see gold rip like this, and silver would be following it, at least with some level of correlation. It feels like gold's been effectively, skyrocketing, and silver's kind of just sat back and been watching this. My understanding is that historically silver is the catch-up trade. When everybody feels like they've lost out on the gold trade, they start to hop into silver. Why do you think that hasn't happened yet?
Well, first of all, the gold to silver ratio has only been this high maybe two or three times in history. And it represents what I believe silver does as the most undervalued asset on the planet. 100%. And you're right. Typically, gold will go first, silver will lag behind it, usually during the initial phase. Um, but then typically slingshots and catches up, delivering 2 to 5 times greater returns if history is any guideline. The historic average for 5,000 years was 16 to 1, 16 ounces of silver for every 1 ounce of gold. That was the geologic ratio and the price ratio for over 5,000 years. When we hit the Industrial Revolution, man's ratio, not God's ratio, the mining ratio of 16 to 1 has been since then roughly 42 to 1. That's been the average price ratio. But my buddy Keith Newmeyer, who is in your neck of the woods up there in Vancouver and the CEO of First Majestic, has told me many times, both publicly and professionally, or personally rather, that the real ratio right now is 7 to 1. That silver is found in nature like your skin is epidermis, and silver is found very near the surface. It's called epithermal, and the big deposits were found decades ago. With the current level at 100 to 1, you're talking maybe one of the greatest opportunities I've ever seen. Anytime silver gold ratio gets above 80 to 1, silver is poised for a breakout. I do believe we will see that breakout. But in my belief, am I able to share my screen with you? I want to show you why I think this was let me open this up. This was a presentation I did at Rick Rule's. I think this is it. Yeah, here it is, at Rick Rule's conference. Let me share my screen here. This is a can you see that? Okay, this is a presentation I did at Rick's conference last year. So this is all last year. But that S.2768 is a Senate subcommittee bill in 1942. And if we just read the first paragraph, the present consumption of silver for war purposes is at the rate of about 100 million ounces a year and is growing rapidly. According to the War Production Board, it's only a matter of months before war demands will have increased sufficiently to require at least 200 million ounces of silver per year. So silver used to be openly talked about in its military capacity forever. So here are last year's supply demand numbers, which show a 265 million ounce shortfall. All right, here's the supply or the demand right here. Okay, here's the demand. Industrial, 9%. Electrical and electronics, 9%. Photovoltaics, 20%. That's solar panels. Brazing, alloys, and solders, 3. Other industrial, 9. Photography, -3. Jewelry, 4. Silverware, 7. What are we missing? Where's military? Why is military not in there? And maybe this is why silver hasn't performed. This is the COMEX market. The red line represents the biggest 4 commercial banks that are short silver. The green line represents the 4 plus the other 4 big banks. These are 8 Western commercial banks that have the largest short position on silver of any commodity they trade. Now, why the hell would 8 banks, when you have India importing 900 million ounces in the last 5 years, when you have Russia openly saying we're going to add it to our strategic stockpile, when you have China right now, which is the second largest producer in the world, they think they're number 1, but let's just call them the second largest producer in the world. And ask Keith Newmeyer about this. Ask Sean Kunkun about this. They're flying. Sean told me to my face, Andy, they are flying all around, and he's the Dolly Varden CEO. Or they're flying all around Latin America, in particular Peru, going right to the miners. Remember, the second largest producer in the world. What the hell do they need to do this for? They're going to the miners directly and saying, listen, we'll take your doré and your concentrate, which is crudely refined doré bars before they're sent for further refining and purification, and the sludge, the concentrate. We'll take it all. We'll pay double what the West will, and then we'll send it back to China for further refining. They're using the suppression against us. They're standing for delivery in London. They're standing for delivery on COMEX. They're standing for delivery in Shanghai. But you have 8 banks suppressing the price of silver. And this is what happens when 8 banks suppress the price of silver. These are the London vault totals. So let's suppress it, and the world gets wise to it. They are sophisticated, coordinated, motivated, wealthy, and they are standing for delivery, draining the LBMA. These numbers are below now. They're about 760 million ounces, not 800, of which over 500 belong to the ETFs. They only have 250 million ounces or so available, but they're trading 2.9 billion ounces a day. Are they out of their freaking mind? 2.9 billion per day. 3.5 times global mine supply against a float that's 10 times less than that. And this is because the military industrial complex needs to make high-tech weapons, doesn't want the world to know about it, suppress the shit out of the price. And think about it. They own BlackRock, as an example, who is the primary custodian along with JP Morgan for SLV. They just took over, both of them, JP and BlackRock, as the primary custodians of GLD, SLV and GLD, massive holders in PSLV. And so they own the majority also of the military contractors, almost all of them. And so they make the weapons, high-tech weapons, to sell around the world, and then you watch them blow up in places like Ukraine. And then who gets the reconstruction contracts? Oh, that's right, it's BlackRock. BlackRock gets the reconstruction contracts. So if you want to shut off that spigot of nonstop money to the military-industrial complex, well, let silver go to the moon. If not, these banks who are stupid enough to maintain the largest concentrated short position in any commodity ever traded, this is what happens. And so these countries understand what we're up to, and they're using the suppression against us. We will wake up one morning and see silver go to the moon. And at one last point, and I'll just simply say that, the BRICS has been my main focus for a long time, and not so much right this moment, but it has been for the last 4 years. And last year they were building the BRICS grain exchange, and and they're building right now the BRICS precious metals exchange also. But the BRICS grain exchange, when they were building it, the guy who was running it said, we produce and consume more grain than they do in the West, and yet we can't control the price. It's controlled on COMEX. But with the development of the grain exchange here for the BRICS, that will change. Well, do you not think they understand this as it pertains to metals also? The Chinese have bought the LME, the London Metals Exchange, the base metals, copper, zinc, that kind of stuff. And they know exactly what we're doing with precious metals. And this is why they have quietly, slowly, methodically, playing the long game, been standing for delivery all around the world through not just their own central banks, which are reported to the IMF, but through sovereign wealth funds and through commercial proxy banks on behalf of the PBOC or the People's Liberation Army, the PLA. They stand for delivery. That's not reported. So the world is slowly draining the exchanges, using the stupidity of Western suppression within gold was used to support the illusion of the strength of our bond market and our currency. In silver, it's to build weapons and to maintain the supremacy and the cash cow that is the military industrial complex, blow up the world, and then go help them rebuild it and rinse, wash, and repeat all around the world. And that's what they've been doing. So why hasn't silver taken off? Because it's been suppressed wholeheartedly by the West. That's coming to an end. And being naked short, as we were talking about earlier, in this environment where countries are wealthy, sophisticated, and motivated and understand the game, is as stupid as a mud wall. And I think you will see this unfold more and more and more and more. I like the term logarithmic decay. Little by little by little, then bang, all at once, you wake up and what the hell just happened to silver? It's at 80, 90 bucks. Last point, if you take gold right now at 34.20 and divide it by 42, which is its 200-year averaged price, 34.20 divided by 42. If we woke up tomorrow morning and silver was 81 bucks, well, that's where it should be based upon the last 200 years of average price. But if you take 34.20 and divide it by 7, well, that's 488 bucks. That is the geologic ratio right now, and Keith will admit that. So if someone said silver could go to 500 bucks, are they stupid, or are they just actually speaking in terms of real geological principles? The answer that I would come up with, well, yeah, it's legit. Could it happen? Don't know. Markets go higher than anyone ever thinks possible, and bear markets fall further than anyone thinks possible. So from my standpoint, the term asymmetrical, there it is.
Okay,
It has the greatest asymmetrical profile I've ever seen, meaning lowest downside, highest upside. I don't know of an asset that would be better to own, especially for someone your age or younger folks who are looking for something that gives them tremendous upside potential while really a muted downside risk.
And there's nothing more asymmetric than the logarithmic curve, right? Uh,
Yes, exactly.
well, Andy, thanks so much for hopping on here today. It's been really great to get your insights. Hopefully, you'll do this again in the future.
I'd love to.
And I think that we've got a really exciting time ahead of us for those of us who are bullish on precious metals. So, thanks so much for doing this, and let's do this again soon.
I'd love to, Steve. Thanks for having me, man.
All right, everybody. Thank you for watching. If you enjoyed this interview, smash that like button, subscribe, and ring that notification bell. Guys, also let us know what you think in the comment section. Thanks for watching, everyone.